Alrighty, so obviously I want to try and show you, a decent amount of trade examples so you guys can truly understand, this entry model inside out, and then you can go away and do your own testing before potentially implementing it into a live market if so choose to do so. But the way I think it will be good to kind of go through these examples is how you can probably see I'm splitting them up between what I believe to be low probability setups, the medium probability setups, and then those high probability setups. Now, obviously, it's a bit of discretion as to exactly how you categorize the trades between those, but I'm going to try and make the distinctions as clear as possible. And we'll go from there. So really, in my opinion, what defines probability is wrapping your head around the medium time frame phases cheat sheet. So if you haven't seen this original lesson, I'll link it below in the notes below the video. Please make sure you're very comfortable with it. If you've been here a while in Photon, or if you've watched the course already, you should get this. And really what this medium time frame phases cheat sheet does is it distills sort of everything that's bubbling away in my subconscious of how I read the market and sort of the years of experience that's in there. We try to distill it into sort of this mechanical cheat sheet so you can kind of understand how to think about the market in almost every single scenario and phase that it can be in, to then go, right, I'm in phase C, this is what the objective of phase C is, right? If we look over here to the right, and therefore these are the best times in which I want to be trading that, trading price action if a setup occurs, if it's in phase C, right? So that way you can kind of know how to deal with the many variables of the strategy, right? Because we can all find a medium time frame zone and we can all then see the entry model in there and then hit it. But really what will separate, your results from losing or from break even to then actually truly pulling away, having that higher strike rate and starting to compound your results in the long run will be wrapping your head around this, in my opinion. So what I would encourage you to do is when you begin your testing and also when you're live trading and you're forward testing it, make sure you journal and categorize the trades in these phases. And then when you have collected a big enough sample size that is, hopefully statistically significant, you will start to see those stats come through and realize, in some scenarios, actually these phases, I have a much lower strike rate in, or they're just not really overall giving enough return for me to justify trading when prices in those phases, right? The data will kind of show that to you. So first one we're going to kick off is low probability. Let's look at what those setups are. And generally, at least I have found, they kind of come in these phases. So phase A2, phase B, phase D, and phase ranges. And I'll go through these one by one now to try and make those clear. So what is phase A2? Because this is not something that's on here, and I didn't include it in the original lesson. Well, it's kind of, a slight evolvement. Someone actually first called it in the community. I can't quite remember who it is, so sorry for not giving credit to you. But I first remember seeing someone refer to phase A2, and basically that's when we are trading pro medium time frame swing and pro medium time frame internal structure, right? So it's all aligned, but we're doing it after the boss has occurred, right? So phase A is here when you're pro internal and pro swing, right? We're getting long, and it's here as well where the green box is. But after we get the boss, we know that the internal structure can still stay bullish for a little while, right? And technically this area here is phase A with our cheat sheet, but we're now going to call that phase A2 because buying up here after the boss is very different from buying down here. Okay, why is that? Well, down here, we've pulled all the way back to an area of value. We've mitigated the extreme demand at the strong low, and our internal structure has now shifted bullish, right? So then when we're coming back into here, this is that first end of the pullback. Risk to reward is on our side, and more often than not, this is a really high probable area to get involved to try and capture that next swing leg. Now, obviously, the higher we get within this range, the sort of the lower probability that comes because risk to reward isn't quite on our side as we're coming up towards these highs, or sometimes price can kind of range for a bit before it goes, right? I'm sure we've all experienced that. But phase A2 is when the internal structure remains bullish, but it's after the boss. Now, after the boss, we know what can we expect. We can expect a swing pullback to kick in at any moment. So following the internal structure up here is a lot riskier than buying it down here after that initial IBOS. Okay, so basically we're calling this up here phase A2. And you will find on average, those trades tend to be, or at least I classify them on the lower end of medium probability. And most of the times it's a low probability trade. Okay, because often generally that pullback comes in, or you might get a bounce from medium time frame demand, but you can't quite hit your profit target, and then you get a break even or a loss depending on how you manage, and it isn't quite worth it. So it's not to say that you should never trade these A2 positions. It's just that, again, more often than not, they lean towards the lower end of the strike rate. So you have to be a lot more experienced and disciplined for when to execute them. Generally, I'll kind of show you in a minute when we get into the charts of when to do it, but it's generally when like momentum is super, super strong. It's like the new start of a 4-hour leg or a hard time frame leg. There's no opposing supply or demand or liquidity points in your way. It's kind of almost like where you can see in a chart that like price is almost ready to free fall or fly because there's like nothing in the way. That is kind of when you can get away with it, and I will show you that, okay? But for the most part, after a boss, you want to be a lot more cautious with kind of following the trend. And yeah, that would just be my general advice. The next one is phase B. Now this is when you are trading in line with the swing structure, but you are against the internal structure. And I've said here when the best time is to trade phase B, and it's basically here. It's pretty much when you come into the extreme strong swing low and you are expecting the internal structure to shift bullish, right? Because it's going to have to shift bullish here if the swing structure is going to stay bullish, right? If this low is going to hold and we mitigate the extreme level of demand, right, then we're expecting the internal structure to reverse. So that's the best time to trade against the internal, right? Because it makes sense that we're about to see that reversal. This is the best time to trade phase B, right at the extreme. And even maybe waiting for like an M15 chalk or a medium time frame chalk can even help with that, because at that moment you are trading against that internal structure and order flow, right? So this is an okay area to trade phase B. But generally the areas you get caught out that I view a low probability are when you do it, say like here, or maybe even like here, right? Because technically both of these areas are the same. They're both phase B. If you're buying, you are trading in line with the bullish swing structure, but you're against the internal structure. And the reason why here and here are far lower probability than here is because in these areas, if price mitigates something to the left here, what is the probability, you have to ask yourself in each scenario, what is the probability that the swing pullback is going to end here and we're going to see that internal reversal and we're going to go? Well, if there's demand lower down, if we're selling off with a lot of momentum, et cetera, then it's unlikely, right? Until we come down here. So that's why phase B is generally a bit of a lower strike rate unless you do it in the right areas, or you have good reason, good confidence to believe that these areas is where you're going to see that next leg. Or you have enough risk to reward just to play that internal pullback. You take your profits, you get out, you remove your risk. And then again, if you can get in early, maybe there's like a demand zone here, right? It's a bit more advanced. You have to have experience to know when to do that and when not. Generally, it's best to always be trading in line with the internal structure. You almost always want to be trading pro-internal or at least pro-fractal order flow. Like wait for that medium time frame chalk first and then get involved, okay? The next obvious low probability one, which you're probably all aware of, is phase D, and that's when you're trading counter swing and counter internal. So you're just basically trading against everything on your medium time frame, right? When you're trying to short here, when everything is heavily bullish. Now I've gone into a lot more detail in the MTF phases lesson of when to do it. There's some more information in here. I don't want to make this lesson super long, but I would just say, just avoid this. Don't even bother doing it until you're a lot more experienced. And at a minimum, I would wait for like generally at least a medium time frame chalk, and you want to be doing it from a very decent supply and demand zone, generally backed up by the higher time frame, okay? But this is a very easy one to just leave out of your plan and not get FOMO if a setup plays out. Fine, whatever, it's fine. Just wait for phase C. This is a lot better, okay? So D is an easy one to leave until you're consistent. And then the final one is ranges. So very simply, this down the bottom, when there's no real clear higher time frame intentions, it happens, quite a lot of the times throughout the year. We'll just have the 4-hour ranging for a month or so. And ranges can be played, but there'll be times where like it's super messy or price is right in the middle. You will find that in the long run, you can probably break even or do quite, be profitable. But for the most part, it's easier just to stay out because you'll find the strike rate is a lot lower. So that's my experience on my own trading, my own data collection, and also what I see in the community where the majority of people take their losses. So it's not to say that you cannot trade any of these phases. It's just to say that these are typically a lot harder to trade with a higher strike rate. So just bear that in mind and use these phases to help categorize your trades when you are trading, when you're collecting data, and it will all start to become a lot clearer to you to help you to know how to approach those scenarios and whether you want to trade them or not. Okay, so hopefully that makes sense. Now let's just go look at a couple examples of what typically, not always, but typically are these lower probability setups.